Consistency in trading doesn't come from luck. It comes from mastering tools that actually work. Welcome to the ComLucro channel. In today's video, we're going to break down a strategy that combines two of the most reliable technical indicators in the market, Bollinger Bands and RSI. Used correctly, they can help you identify high-probability setups with clarity and discipline. We'll start by showing how each indicator works on its own, and then demonstrate how to combine them into a structured, rules-based approach. This is not about predictions, it's about using objective data to make better decisions. At ComLucro, our goal is simple: to help traders move away from emotional decisions and into a consistent, methodical process. If you're looking for shortcuts, this isn't the channel for you. But if you want practical strategies you can apply right away, you're in the right place. Before we jump into how Bollinger Bands and RSI work together, it's important to understand the core principles behind each tool. And there's no better way to do that than by hearing directly from the creator himself, John Bollinger. In the next clip, you'll hear his insights on what Bollinger Bands are really designed to do, how traders often misuse them, and how to apply them across multiple time frames.
Trading bands are, I think, probably one of the most misunderstood of all technical tools. People think that they give absolute kind of buy and sell signals, that if you tag a trading band, it's automatically a sell signal. If you tag a band high or tag a band low. What trading bands really do is they don't generate signals in and of themselves. They give you some information. They answer a question. And that question is whether prices are high or low on a relative basis. So by definition, prices are high at the upper band, prices are low at the lower band. And it turns out that those definitions are really useful definitions, that we can use them to build rigorous trading approaches. So I think people expect a little bit too much from trading bands just by themselves, and that what they need to do is kind of accept a simpler idea of what trading bands are about, and then use that information that they generate to build rigorous trading approaches. There was a guy by the name of Sam Kashigan. He wrote a number of very interesting statistics books, and a very, very long time ago he designed a system called the Lennox system. He required the same patterns to occur in 3 different time frames in order to get a signal. And we find that with Bollinger Bands it's quite often the same. There are 2 ideas that seem very interesting. Number one is if you just combine different kinds of Bollinger Bands on the same chart, you get very interesting information. For example, if you combine 20-period Bollinger Bands and 50-period Bollinger Bands, you find that at certain points they line up, they come together, and they give you useful trading information. Another sort of thing is if you're mindful of the sorts of tasks that traders assign to different time frames, you can use Bollinger Bands in different time frames. For example, we have typically short-term, intermediate term, and long-term. Intermediate term is the time frame which you do your primary analysis. It's the time frame which you make your buy and sell decisions and monitor your positions. Short term is used exclusively for executions, for getting the proper fills, for setting your stops and such like that. Long term is used for background information, for providing environmental information. So you might use, in the intermediate term, you might use 20-period Bollinger Bands on a daily chart to arrive at a buy or sell signal. In the long term, you might use 20-period Bollinger Bands on a weekly chart and only accept the buy signal from the intermediate term if you had a similar buy signal from the long term. So you could use the environmental information as a filter to guide your intermediate term operations.
Now that you've heard directly from John Bollinger and understand the concept behind the bands, let's move into the practical side. We'll start by setting up the Bollinger Bands. If you're new to using Bollinger Bands, you've made the right choice clicking on this video, because this indicator is a game changer for identifying key support and resistance levels in the market. To begin, open your charting platform. Whether it's TradingView or any other tool you prefer, click on the Indicators tab and search for Bollinger Bands. The default settings on TradingView are fine, but for this strategy, we'll need to make some adjustments. First, go to the length section and set the value to 30. Make sure the standard deviation remains at 2. After that, I personally like to remove the background shading from the indicator and change the lines to red. This step is entirely up to your personal preference, so feel free to customize it as you see fit. Now, if you're unfamiliar with how Bollinger Bands work, here's a quick breakdown. The center line represents a moving average, calculated by going back over a defined number of candlesticks, 30 in this case, and averaging their values. The upper and lower lines indicate the standard deviation, which helps measure price volatility. Now that the Bollinger Bands are set up, let's move on to adding the RSI. Open your Indicators tab, type in RSI, and select the option labeled Relative Strength Index. Once the RSI is added to your chart, we'll make a few adjustments to its settings. Set the upper band to 70 and the lower band to 30. By default, the length is usually 14, but for this strategy, we'll change it to 13. For those unfamiliar with the RSI, it's a highly effective tool for determining whether an asset is overbought or oversold. When the RSI line is above 70, it indicates that the asset is overbought, meaning it might be due for a pullback. When the line is below 30, it signals that the asset is oversold, suggesting a potential rebound. Now it's time to combine these two indicators and start spotting profitable trade opportunities. Stick around, because later in this video, I'll share a crucial tip that can take this strategy from being just decent to becoming a powerful money-making tool. There are two main strategies we can use with these indicators, both grounded in the concept of mean reversion. If you're not familiar with this term, here's a quick explanation. Mean refers to the average price, while reversion means moving back toward it. In simple terms, mean reversion is the idea that after significant price movements, the market tends to return to its average level. This is the core principle behind the strategies we'll explore. Let's look at an example. After an extreme price movement in one direction, either up or down, it's common to see the price eventually return to the average, which in this case is the moving average. If the price moves above the upper Bollinger Band, that's a signal to consider entering a short trade. If it moves below the lower Bollinger Band, it's a signal to consider entering a long trade. Sounds simple, right? But if you were to rely solely on this, the chances are it wouldn't work consistently. That's exactly why we've added the RSI to the mix. Here's why. The price often moves above or below the Bollinger Bands multiple times, which can lead to many false signals. If you entered a trade each time this happened, you'd likely lose money. To filter out these false signals, we've added a crucial condition: only trade when the RSI reaches an extreme value. Specifically, enter a long trade only when the price drops below the lower Bollinger Band and the RSI falls below 25. Similarly, enter a short trade only when the price moves above the upper Bollinger Band and the RSI rises above 75. This additional layer of confirmation helps improve the reliability of your trades. Here's an example using Apple. The price dips below the lower Bollinger Band, but the RSI hasn't yet hit our target level, so we hold off. A bit later, the RSI drops below 25, even reaching 20. At that point, we enter a long trade, and as anticipated, the price eventually returns to the average. Now, there's a critical detail you need to understand for this strategy to work effectively. Without this insight, you risk losing money. The main challenge comes when the market is moving sideways. During these periods, predicting price movements becomes significantly harder, and the usual signals can lead to unreliable trades. Here's an example where things can go wrong. The price drops below the lower Bollinger Band and the RSI falls below 25, yet the price continues to decline. If you entered a trade here, you'd face a significant loss. To avoid situations like this, here's a helpful trick. Notice how in this example, the Bollinger Bands are extremely narrow, closely hugging the price. The RSI is also relatively flat, staying within a tight range inside the purple rectangle without hitting any major extremes. This is a clear warning sign. When the market behaves like this for an extended period, any breakout is likely to carry strong momentum in one direction. In these cases, it's best to avoid trading and resist the temptation to catch a falling knife. Here's another way to refine this strategy. Take a look at this example. The price drops to the lower Bollinger Band and bounces back. The next time it moves down, it forms a new lower low. However, here's where it gets interesting. The RSI forms a higher low. This is called divergence, and it's a powerful signal to enter a trade. Divergence is especially strong if the RSI was previously below 25 and the price had already touched the lower Bollinger Band. When you see this setup, there's a high probability the price will reverse and make a higher high. In conclusion, combining Bollinger Bands and RSI gives you a powerful framework for identifying high probability trades, especially when spotting key setups like divergence. But mastering a strategy is only part of the game. As Dr. Alexander Elder reminds us, trading success isn't about complex math or academic titles, it's about emotional discipline. The market won't give you structure. You have to build your own.
Individual psychology of a trader. There was a professional trader and money manager in Chicago, the guy by the name of Brian Monison. And he famously said in an interview, "I have a PhD in mathematics, I specialize in cybernetics, but I was able to overcome these disadvantages and make money." Being highly educated is a negative when it comes to trading. The more formal education you have, the bigger the obstacle you have to overcome. Why is it so? We're dealing with only 5 numbers: open, high, low, close, and volume. There is nothing terribly hugely sophisticated about it. I mean, you have to be able to count, and you have to be able to count in your feet. If I say to you 20% of 87, approximately how much it is, I'd like you to be able to answer that question without a calculator. Those things you have to do on your feet. But you certainly don't need algebra, you don't need higher math. Emotionally, trading is the hardest game in the world. And it's so terribly hard because like nowhere else, the game is entirely up to us. The game begins when we put on a trade, and the game ends when we take off a trade. There is no structure. We create our own structure.
So as you take this strategy and apply it in real time, remember, your greatest advantage will never be your tools, it will be your mindset. And if you're ready to keep growing, don't miss the free courses available right here on the channel. Whether you want to decode market behavior with the Wyckoff method, build a solid base with our technical analysis for day traders course, or dive into institutional logic with smart money concepts, we've got everything you need to level up. Stay focused, stay disciplined, and as always, best of luck in your trades. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube.